For more on the markets, we are joined now by Michael McKee, once again, Bloomberg's international economics and policy correspondent, who's had a busy week talking with a lot of Fed policymakers. And Mike, that's where I want to start. One of the policymakers with whom you spoke was Tom Barkin of the Richmond Fed. You asked him about oil prices. Let's take a listen to what he had to say about how this might affect the U.S. economy going forward.
Don't have any sense on how long it's going to take or what the implications are going to be. Obviously, you watch oil prices. While the U.S. is no longer a net importer, it's still the case that the price at the pump matters a lot in terms of sentiment, in terms of crowding out other spending. And so I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
We'll see where it goes. Michael McKee, we've been talking about that in the geopolitical context. A lot of folks watching this war unfold unsure of that. You have economic policymakers who are very much in the same boat, kind of wondering with no real information about how long this is likely to drag on. How much of a difference does it mean the longer it does?
Well, the longer it does, the worse the impacts are going to be. Again, to go back to what I said earlier, it's probably not going to be a recession, but you're going to see maybe people pulling back on spending. There's a kind of rule of thumb that for every dollar price of oil goes up by the barrel, it's about 2 cents for a gallon of gasoline. But if it drags on, that drifts up to 4 cents. So it's definitely already noticeable for Americans. And the question is, are they going to start pulling back on other expenditures because they have to put that money into their gas tank? And that's what the Fed doesn't know. Now, the Fed also knows that lowering interest rates with gasoline prices going up isn't going to bring them down. And we learned a lesson in the 70s that just leads you to inflation. So they're not going to react to this. What they'll watch for is that knock-on effect doesn't get into other parts of the economy.
I mean, my first question is, do you also have Tom Keene in your head? And is this something that I will soon have? I'm new to Bloomberg. I don't know if this is a rite of passage. We'll circle back to that. But I do also want to ask you about Friday's jobs report. Obviously, it came in a lot lower than expected, triggering broad market sell-offs. How are these two things related, and what does that mean for the overall health of the economy?
Well, they're really more related in a political sense, and it's tough for the president because, of course, gasoline prices are very bad for the Republicans in the midterm elections, and the fact that people are not getting jobs is also very bad.
Right, we heard the administration blaming cold weather and a couple other factors.
Yeah, it really wasn't cold weather. There were some adjustments statistically, but the number of people who couldn't work because of the weather was not out of line with what you usually see in February. It was just basically a weak report. Now, for the Fed, it's tough because it puts them on both sides of their mandate. They've got a weakening job market, which means they should maybe think about cutting interest rates, but they've got inflation going up, which means they should probably think about holding, if not raising rates. So they're kind of stuck. And I go back to what Tom Barkin was talking about right now. The best thing for them to do is just sit and watch what's going on.
Talked to Tom Barkin, you talked to Austin Goolsbee, the Chicago Fed, and this is something that you and he had a little colloquy about, the way that this is complicating the Fed's calculus and thinking going forward when it comes to inflation. Let's take a listen to what President Goolsbee had to say.
I remain hopeful / expecting that conditions will improve, that we'll start to see some progress on inflation, head us back to 2%, and by the end of this year, that we would be in a situation that we could commence our march back down to something like the settling point.
Mike, give us a fuller sense of what President Goolsbee and others are thinking. I know there's a school of thought here that you have this dramatic incident, this war in the Middle East, but with big events like this in the past, there's been some inclination on policymakers' parts that they can look through it. They can look through a big event like this, particularly in the context of inflation. What did he say about that and sort of how he's thinking about that dual mandate in light of what's happened here over the last week?
Well, everybody says they should look through it, all members of the Fed, because they know that energy prices go up and stay up temporarily and then come back down, and by the time the monetary policy move you make hits the markets, it's already going to be it's going to be too late. So for them, it's a question of sitting tight or when can they get back on the idea of cutting rates? Now, certainly the Fed's divided, and there's a group of members of the Open Market Committee who don't want to cut rates any further, absent a war. But for the majority, it's still a feeling that they're a little bit above neutral and that they could come down a little more, and it's a question of what are the data going to be telling them, what kind of permission do they have to move forward? And while there's all this uncertainty about prices and jobs, they can't move forward.
All right. You were a very busy man. You also spoke with Beth Hemmick, who's the Fed Reserve at Cleveland. And speaking of monetary policy, you asked her kind of about the ultimate victor in the battle of the Kevins, and that's Kevin Warsh, and what role that he's going to play in making these decisions. Let's take a listen.
Whoever walks into that role, the chair seat is a particularly influential seat. They historically have tried to bring the committee together, get a perspective on where people are, and I have every confidence that Kevin, if he assumes the job, is going to do his absolute best for the American public, like all the rest of the 18 of us do around that table.
So with a divided Fed, will that person be the ultimate arbiter of how this decision is made?
Well, that would be the case if it were still Jay Powell. The issue is that the president is expecting Kevin Warsh to come in and immediately lower interest rates, and one man can't do that. There are 19 people on the committee. The chair's power is basically the power to persuade. And that was kind of the impetus of my question to Beth was, how soon will he be able to be persuasive? Because he's new. He's coming in. People know him, but he hasn't been in the chair where your job is try to gather all the sheep together and get a consensus on what's going on. And so everybody I talked to, including Beth Hemmick, said that they think he's going to be able to do that he's got the kind of personality and the experience at the Fed to do that, but they don't know exactly when that's going to be. And in a kind of funny way, the war helps Warsh out in that we're saying now these people can't really move until the data change. So he can come in and he can tell the president, well, I'm sorry we couldn't cut rates because
our hands are tied.
Because our hands are tied,
You spoke to these three officials on the eve of the blackout period. We're not going to hear from them anymore until the next Fed meeting.
A lot of people are happy about that.
There you go. Until the next meeting, which is in about 10 days' time. Get us up to speed on sort of what's going to be added to that panoply of data in the days to come. So we got this jobs report, and we've drilled into that a little bit here. But as they kind of look at a picture of this economy, and I should say the jobs report, obviously data that was before the war began. I'm curious of what they'll be looking for and what's going to determine the tack that they take going into that meeting on the 17th and 18th.
Well, all of the data they're going to get basically was before the war began. But what we're going to see is another CPI, another PPI, and another PCE. And the PCE is the inflation index that the Fed uses, that the Fed targets. And CPI is probably going to come in reasonably low as it did last time because there are some distortions in it left over from the government shutdown. PPI last time came in high, and it came in high on goods because of the tariffs. The question is, do we get to the end of that process? Are we going to start to see that level out because tariffs aren't going up anymore? And then the PCE is affected by both of those, and it's been hot. And the people who are nerdy enough to go in and put all this stuff together in advance are thinking we're going to see a strong PCE. So they're going to be in a position where they can't do anything about rates, and there's going to be a nervousness about inflation. So they'll sit tight. What'll be interesting to see is who projects what in terms of the dot plot. They forecast in December that there would be one move this year. Do they take that out of any consideration? Do they add another one in? Where are they on that? And then what are their forecasts for inflation going forward? And all the people we talked to basically haven't changed their forecasts much. They think that second half of this year, prices are going to price increases will start to slow, and inflation will start to slow. But they all admit now we don't know because we don't know how long the war is going to go on.
Can I ask you, just going back to the jobs report, what was most worrisome to you and others therein? So 92,000 jobs lost. Healthcare had kind of been buffeting the jobs market for so long. I saw in one note, I think it was some high-frequency economics commentary, that this is a jobs report that will get the Fed's attention. What beneath the headline numbers was most startling or is more likely to get the Fed's attention?
I think the biggest thing, there was little job creation in any category. There was no breadth of job creation.
Even healthcare, right?
Healthcare was affected by a strike, 31,000 nurses off the job on the West Coast.